Physical cash. This is the oldest and most recognizable form of central bank currency, made up of paper banknotes and metal coins issued directly by a country's monetary authority. It exists in physical form, meaning it can be used without electricity, internet, or any digital infrastructure. This makes it extremely reliable during emergencies such as power outages, cyber attacks, or system failures. Physical cash is also anonymous, allowing people to transact without leaving a digital trace, which is important for privacy. It is widely accepted across all types of businesses and regions, including places where digital payments are not available. In many countries, cash still plays a critical role in everyday life, especially for small purchases, informal economies, and older populations. Central banks carefully control how much cash is in circulation to manage inflation and ensure trust in the currency. Even as digital payments grow, cash remains a fundamental part of financial stability and a trusted store of value. Reserve balances. These are digital funds that commercial banks hold in accounts at the central bank, forming the foundation of the entire banking system. While invisible to the public, reserve balances are constantly moving behind the scenes whenever money is transferred between banks. For example, when someone sends money from one bank to another, the transaction is ultimately settled using these reserves. Central banks require banks to hold a certain level of reserves to ensure they remain stable and can meet withdrawal demands. Beyond that, reserve balances are a key tool for monetary policy, allowing central banks to control liquidity, influence interest rates, and stabilize the economy. During financial crises, central banks can inject more reserves into the system to keep banks functioning and prevent collapse. This system ensures trust between financial institutions and keeps the payment network running smoothly at all times. Central Bank Digital Currency, CBDC. This is a digital version of a country's official currency, issued and backed directly by the central bank. Unlike cryptocurrencies such as Bitcoin, CBDCs are centralized and fully regulated, meaning their value is stable and tied to the national economy. They are designed to combine the safety and trust of traditional money with the speed and convenience of digital payments. CBDCs can reduce transaction costs, improve payment efficiency, and expand financial access to people who may not have bank accounts. Governments are also interested in CBDCs because they provide more control and transparency over money flows, which can help reduce fraud and improve tax collection. However, they also raise concerns about privacy and surveillance. Many countries are currently researching or testing CBDCs as part of the future of money. Retail CBDC. This type of central bank digital currency is designed specifically for everyday people and businesses. It works like digital cash, allowing individuals to store and spend money through digital wallets, mobile apps, or payment cards. Retail CBDCs can be used for daily purchases, such as groceries, bills, and online shopping. One major advantage is that people may not need a traditional bank account to use it, which could help bring financial services to unbanked populations. Transactions can be instant, low cost, and secure, even across borders in some cases. Governments may also use retail CBDCs to distribute social benefits or stimulus payments directly to citizens. However, implementing this system requires balancing convenience with privacy and security, as well as ensuring it does not disrupt the traditional banking sector. Wholesale CBDC. Wholesale CBDCs are designed for use by financial institutions rather than the general public. They focus on improving large-scale transactions between banks, such as clearing and settlement processes. Currently, these processes can be slow, complex, and expensive, especially for international payments. A wholesale CBDC can streamline these operations by enabling near-instant transfers with reduced risk and lower costs. It can also improve transparency and reduce errors in financial systems. This type of digital currency operates behind the scenes, but plays a major role in making the global financial system more efficient. Many central banks are experimenting with wholesale CBDCs to modernize infrastructure and handle increasing transaction volumes in a digital economy. token-based CBDC. This form of CBDC is based on the concept of ownership of a digital token rather than identity. If you hold the token, you own the money, similar to how physical cash works. Transactions are verified by confirming the authenticity of the token rather than checking the identity of the user. This approach can offer higher levels of privacy and simplicity, as it does not require extensive personal data. It also allows for more flexible and potentially offline transactions. However, it comes with risks, such as loss or theft of the token, since ownership is tied directly to possession. Designing secure systems for token-based CBDCs is a major challenge, especially in preventing fraud and duplication. Account-based CBDC. In contrast to token-based systems, account-based CBDCs rely on verified identities and registered accounts. Users must authenticate themselves to access and transfer funds, similar to how traditional banking works today. This model allows for stronger security, better tracking of transactions, and easier enforcement of regulations such as anti-money laundering rules. It also enables features like account recovery if access is lost. However, it requires more infrastructure and raises concerns about user privacy, as transactions can be monitored. Account-based CBDCs are often seen as more practical for governments because they integrate more easily with existing financial systems. Programmable money. Programmable money is an advanced concept where central bank currency can include built-in rules and conditions. This means money could automatically behave in certain ways based on predefined logic. For example, funds could be programmed to be spent only on specific goods, expire after a certain date, or trigger automatic payments when conditions are met. This opens up many possibilities, such as reducing fraud, improving efficiency in government spending, or automating business processes. However, it also raises important ethical and economic questions about control and freedom, since such money could limit how people use their funds. As technology evolves, programmable features are likely to become a key area of innovation in digital currencies. Synthetic CBDC, SCBDC. Synthetic CBDCs are a hybrid model where private companies issue digital money that is fully backed by central bank reserves. In this system, the central bank provides the stability and trust, while private firms handle customer interactions and innovation. This allows for faster development of new financial services without requiring the central bank to manage everything directly. It combines the reliability of government-backed money with the flexibility of the private sector. However, it also introduces new risks, such as dependence on private companies and the need for strong regulation to ensure stability and consumer protection. Emergency currency. Emergency currency refers to special forms of central bank money created during times of crisis, such as financial collapses, wars, pandemics, or natural disasters. In these situations, normal financial systems may be disrupted, so central banks step in to provide additional liquidity and ensure that people and businesses can continue to operate. This can include printing extra cash, issuing temporary digital credits, or providing direct financial aid. Emergency currency helps stabilize the economy, prevent panic, and maintain trust in the financial system. It plays a critical role in recovery efforts and ensures that essential transactions can continue even under extreme conditions. If you liked the video, subscribe to the channel and leave a comment telling me what you'd like to see in the next video.